Money Show.
Personal Finance with Warren Ingram.
So who's worried about their money? Who's worried about their finances? How to protect yourself from panic in markets? What we've seen over the last couple of days is a big negative market reaction in Mexico to a landslide victory by the new Prime Minister there. Narendra Modi is likely to be continuous Prime Minister of India, but his majority has been significantly slashed. Markets there, as you heard in Eyewitness News, Warren, fallen very, very sharply. The ANC is being given a big hiding, and while it is a key party in any future government, it's lost the authority to govern as it sees fit. It's going to need some friends. It's going to need some colleagues with whom it shall have to negotiate the future of the country. And there's a lot at stake in terms of South Africa because of the noise and the uncertainty around potential outcomes. South Africa's politics is confusing and uncertain, and we have no idea which way this is going to go. So understandably, I think a lot of people are, if not nervous, if not terrified, somewhat apprehensive as to how the deal falls and what impact that has on the value of their investments into the future. So how do we mitigate against the risk of things going pear-shaped?
I think you need to add one more little variable. It's somewhere around November this year, Bruce, which is two rather elderly men trying to contest to lead supposedly the world's biggest economy, and listening to big fund managers of global portfolios. They're desperately worried that neither of these two proverbial turkeys will vote for Christmas. In other words, they won't be the ones to tell the Americans that they need to cut spending, and so very likely that they're going to drive America, towards a fiscal cliff. Let's not say over a fiscal cliff, where eventually America can't afford its debt to fund its debt. So there is a lot going on, and when we're in a situation like this, I think the starting point is to understand that we, in terms of investors, have seen all of this before. And I'm not saying, if you're a 25-year-old investor, you might not have seen, with your own eyes, the big kind of inflation scare in the 1970s, but markets have seen this before. Investors have seen this before. And there is a lot we can learn from history to start. But secondly, what you need to know is that markets tend to price these big events pretty effectively, pretty efficiently over a 5 and a 10-year period. But over a 1 day, 1 week, 1 year period, markets are extremely predictable in being entirely unpredictable and most importantly, very inaccurate in kind of valuing and pricing all of these risks. So the one thing we need to know about markets is, markets don't like uncertainty. So it's a human thing. We don't like uncertainty ourselves, but when you aggregate all of us humans together and you measure our uncertainty by looking at market prices, whether it's stock markets or currencies or interest rates, whatever it is, the one thing we would almost prefer some bad news that gives us certainty than potentially good news with no certainty. And to me, that kind of describes where we are right now. I mean, we're living in a time with this, the kind of not defeat yet, I guess, but the major hiding given to the ANC in the election, where it seems that, to any political commentator out there, we're kind of faced with, on the one side, a coalition of whether it's EFF plus MK plus ANC, or on the other side, the DA plus IFP and ANC, and markets and investors clearly only like one of those outcomes and really don't like the other. And if we're faced with one of two choices, my view is that's a flip of a coin. We don't know. I'm not saying, please don't misunderstand me. I'm not saying the politicians are going to go and flip a coin and decide which way to go, but the odds are heads or tails. And
our ability to predict is effectively as useful as flipping a coin, I think, is your point.
And so when you're in that situation and it is a flip of a coin's kind of probabilities, then what you need to know is no one knows what's going on. And I suspect the politicians don't actually know what's going on just yet. They should get some clarity over the next few days and weeks. In a situation like that, the uncertainty will cause prices to go down. Remember, it's not necessarily that we're going to get a bad outcome. It could be that we get a bad outcome. I don't know. It's a flip of a coin's chances, but equally that means there is a chance that there is a good outcome. And so sitting in a situation like this where you're watching the rand blowing out a bit and you're watching the JSE going down, if you're only predicting in your head a bad outcome and therefore you sell investments, whether it's selling rands to buy dollars or selling your house in panic, people have done that in the past. What you're doing is reacting with equal emotion to the very emotional markets and most likely selling yourself very short. So my first piece of advice is please don't do anything in a panic in anticipation of an outcome which could be as variable as a flip of a coin. You just cannot make a prediction like that. It's really not going to help you in most instances. I think if you look at what markets do, there is a very good argument that the JSE strengthens and the rand gets stronger over the next year or two, almost kind of unrelated to what goes on with the JSE and what goes on with not the JSE, but with our politics. And that's because, if interest rates start going down overseas and there is appetite for emerging market risk, the rand will benefit and the JSE will benefit almost irrespective of what's going on the ground in South Africa. So for you to sell everything you have in this country right now based on things that you can't decide, it's not insane. It's emotional. I understand it. It's not rational, but it could be financially damaging. And I think that's the point here is take your time to act slowly.
Okay. But there are people now shouting at the radio, Warren, saying, but I'm petrified. I would rather take my chances on Trump or Biden or on Sunak or the other guy in Britain or even the crazy one who's just thrown his hat into the ring, Nigel Farage, who's desperately, he knows he won't, Keir Starmer is likely to be the next Prime Minister in the UK. I'd rather take my chances there than run the risk of a radical change in policy or perception of change. And therefore, I'm just bailing. I'm going to cut my losses. I've been patient long enough. This is a government that that has not had my back for some time. Why should I trust them this time round? And that brings all of your beliefs and biases and all of your incorrect decision-making processes to the fore. And as Nassim Taleb put it, and I think in one of his books about 10 years ago, you have to invest in preparedness, not prediction. And I think it's a lot harder to be prepared rather than trying to predict outcomes, which invariably most of us are going to get wrong most of the time.
And even if you get the outcome right, you happen to be lucky or skillful enough to predict the outcome. What you have to also predict is how investors will read that outcome and how they will understand, how they will react to that and respond and price the outcome. And that's much more variable and much more unpredictable. I just think in this situation, if I could give one piece of advice is avoid the predictors for the next 2 weeks. Don't listen to all the hype and don't, someone who was kind of a vaccine expert in COVID and then, kind of an AI expert today and suddenly they're an election expert. What you need to understand is all they're really good at doing is broadcasting their ignorance for everybody to hear in a very convincing way. If you're going to, and it's human nature, we want to kind of arm ourselves with knowledge and information, and that's good.
Absolutely.
Yeah. And go for it. Then, go and read academic research and go and study the outcome of markets of previous elections. I see the CEO of Standard Bank today saying, 8 out of 10 times in the last 10 elections that the markets have gone up. And he's saying he feels that would be a kind of a likely outcome in South Africa. Now that's a prediction, but it's coming from a very smart man who's got his finger on many different pulses in the economy. I'm not going to invest according to his prediction, but what I am thinking is that's much more reliable than my WhatsApp groups, which are going crazy with conspiracy theories.
Warren Ingram is a certified financial planner. He's the co-founder at Galileo Capital. He's with us this evening on how to behave in panic. Do you panic first and get out and cut your losses and potentially run the risk of losing upside? If that makes you sleep easier at night, then be our guest. But sensible guidance coming through from Warren this evening. A letter, an old-fashioned letter on paper, Warren. I'm an engineer working in the mining sector, 41 years old. I'd like to retire when I turn 55. You must be a very good engineer. I think I've got a good idea on how to ride the next big wave and grow my investments significantly. It seems to me the world is going to need lots of copper as we move to electric vehicles. I think it may be wise to allocate a big proportion of my portfolio to mining shares that have exposure to copper. Neo says, do you think this is a good idea? I think I know the answer already now, but we'll get Warren to deliver an answer and we'll fight about it in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So Warren, Neo is a 41-year-old mining engineer, wants to retire in 14 years, believes the best way to secure that is to invest aggressively in mining companies with exposure to copper, because copper's the new gold, I suppose. It's a massively important industrial metal. It's in virtually anything linked to electronics. And with the world moving to cleaner technologies, he anticipates that this is going to be the most in-demand commodity ever. And so to buy the mining companies that produce the stuff is obviously a solution to speedy wealth. These 14 years of wealth so that he can reach his goal of retiring at the tender age of 55. What would you guide Neo in this scenario?
The biggest impact you can have on being sure that you're going to have enough money at 55 to retire now is save like there is no tomorrow. So save as much as you possibly can every single day. Spend almost nothing, live like the hermit on the hill, and save as every cent you can. Waste nothing, don't enjoy anything, and go as hard as you can at building up your money as fast as you can, because the reality is, with the short time frame like that, if you're 41 and you're deciding now to take the big investment risks, that tells me that you're probably a little bit behind on your saving up until now to be able to get there, and now you're looking for the next big thing to kind of give you that head start and get you over the line, in 14 years, and that kind of psychological approach to investing very often leads to the worst possible outcomes, not the best outcomes. And understanding that, kind of taking all of your money, or taking a huge proportion of your money and investing it on one very specific idea. If it works, congratulations. You'll be one of the very, very lucky few that get it right. And I'm using luck in the real sense. It would have been luck. Because even a good idea in a situation like that, it doesn't result in a certain outcome. You have to choose the particular mining companies that actually know how to make money over time, because most of them are very good at using capital over long periods of time. They're not very good at returning that capital to their shareholders. So you're going to have to be the genius that picks the good mining companies, that pick the good copper deposits, that get it to market in the cheapest way possible, and then make the most money out of it. That's a big task. And then you need to be so sure that there will be no new technology that will replace copper, tomorrow. There might be some very bright 21-year-old sitting in university that's just come up with a fantastic way to move electricity in a much more efficient way than copper can. And so taking a lot of your wealth and exposing it to one thing it's sure to give you excitement. That's the guarantee I can give you. It will be very exciting. I'm not sure it's going to be good for your money now. So to me, if you're that determined to get to 55,
psychology or for your health, your psychology or health as well in that particular context, Warren, because if you're going big and you're making sort of what are they called, binary bets. You may get lucky, but the odds are you won't.
Yeah, I think there's a very dangerous game called Russian roulette, where you take a revolver and you put one, bullet in the revolver and you spin the chamber and you've got a 1 in 6 chance of dying. And, it's a terrible game to play. And that's what you're doing with your money when you take a risk like that. You don't want to invest where you can actually blow up your portfolio. So if you've got a strong conviction, then, take a considered view, allocate 5%, or if you really must, 10% of your savings to something like that. I think 10% is far too much, but maybe 5. And if it works out, that 5% will become a very big proportion of your capital, and well done. But if it goes from 5 to 2, you can thank us later.
A quick one. Are you aware of a copper ETF or not? Because if you, to buy the underlying metal, as some people buy gold, some people buy Bitcoin, and some people buy platinum, would you, in 30 seconds, consider it if there was an ETF option?
No, for the same reason that I wouldn't buy a gold ETF. It doesn't generate me any rent, interest, or dividends while I'm holding it, and I need someone to buy it for me at a bigger price than I paid for it, and that's just too risky for me.
Okay. There we go for Warren. Thank you very much, Warren Ingram, who is a certified financial planner. He is a founder at Galileo Capital. He is an executive director at Galileo Capital. Thank you, Nao, very much for a fabulous question this evening. The answer was more comprehensive than I would have given, but it's pretty much along the same sorts of lines. Big bets in markets, if they pay off, are great. And then you'll start believing your own PR. And that's the risk with making big bets that turn out well. And at some point, you run out of luck. That's the big risk you face here. So thank you very much for your question. We look forward to more of those questions, of course, that we can put to Warren on a Tuesday evening at 7:30 as we tackle issues of personal finance. Wrapping up this evening's edition of The Money Show. Thanks for listening.